Right, good afternoon or good morning, everyone. Welcome to our webinar, How Convertible Notes Work, presented by SEEDCHANGE and Early Growth Financial Services. My name is Jason Kennedy from Early Growth. I will be your moderator for today. The webinar is going to last about an hour, and that includes a short question and answer session at the end of the presentation. As you can see in your GoToWebinar panel, there's a questions section. If you have questions throughout the webinar, you can put your questions in through that panel. We will attempt to get through as many questions as possible, either within the presentation or during the Q&A portion afterwards. Any questions we can't get to during the presentation, we'll follow up with afterwards. And as a quick reminder, this presentation will be recorded. You will receive an email with a link to this recording within 48 hours of the conclusion of the webinar. So without the boring stuff out of the way, let's meet our panelists for today, starting with Kevin Smith, founder and CEO of SEEDCHANGE. Kevin, welcome aboard.
Thanks very much, Jason. It's a pleasure to be here again doing this webinar with everyone. SEEDCHANGE is, I'm told, the world's first early stage online broker-dealer. All we do is we work with early-stage companies to help them get funded better and faster. And I've been doing this for about 3 years now. Before that, I was a product and legal guy in iShares, working around the world, launching new funds. And before that, I was a lawyer. So I think of SEEDCHANGE as me having finally figured out what I wanted to be when I grew up.
Great, thank you, Kevin. And from Early Growth Financial Services, Principal and Consulting CFO, Sirk Roh. Sirk, please say hello.
Good morning, good afternoon, everyone, and thanks, Jason. Just a little bit about myself. I've been a financial executive working with high-tech companies for the past 25 years. Been working with Early Growth now for about 5 years. And Early Growth we are a full-service accounting and financial consulting firm, and we basically provide, and we work with typically small to medium-sized companies who don't necessarily need to or want to be hiring people full-time on their staff, and we provide 4 services. We do corporate tax returns, and we do company valuations. So when a company is at the stage where they are giving out stock options to their employees, they need to be valuing their company, and so that they are setting a strike price for their stock options properly, and that has to be done once a year. At a minimum. So we do those 2 services, and then in addition to that, our core service is a consulting service where we provide both day-to-day and month-to-month accounting services and bookkeeping services, and we also provide CFO-level services. So for many of our clients, we basically become their accounting department, and we go in as a team of 2, an accountant and a CFO, to basically handle all of their financial and accounting needs.
Great, thank you very much, Sirk. Thank you to both gentlemen for joining us today. So with that being said, let's jump right into it. And what is a convertible note? And Kevin, why should entrepreneurs care about this and what they are in the first place?
Sorry, I was on mute. First, a little bit of a history lesson. Convertible notes really come out of the 1990s when they first started being used in the technology sector as a bridge between rounds. So let's say you had raised $10 million in your Series A round. You weren't quite ready to raise that $50 million Series B, but you needed a little bit of extra cash, maybe a quick $1 million, in order to open the second office that you wanted, that you saw enormous opportunity for in New York, and you figured that was going to cost a few $100,000. You could do a convertible note quick and fast, and generally, relatively speaking, cheaply. And so it emerged as a bridge round between what we normally think of as the traditional A, B, C, D rounds. At some point, people in Silicon Valley kind of took stock of the difference between doing a normal equity round and how quick, fast, and cheaply you could do a convertible note, and thought, why don't we do this for other rounds as well? And it became used really by 2010, 2012, in Silicon Valley at least, was the absolute standard for early stage rounds. And by early stage, I mean seed or angel funded rounds. So typically rounds of a few $100,000 to maybe $1 million or $2 million. It's not quite the same level of usage in all parts of the world. And kind of as a general rule, the farther you get from Silicon Valley, or really the farther you get from the coasts in the United States, the less common it is, the more likely you're going to find investors, even at a seed round, even if you're only raising $100,000, are still expecting equity. And I fully expect that the rest of the world catches up to what goes on in Silicon Valley over time. That's what we've been seeing for the last several years. They are still used as bridge rounds, and I see pretty commonly now too used as a supplement. You may be doing a Series A round, maybe you've already closed, you're close to closing, but you suddenly got somebody else who's come in and said, I'd love to be part of this. I'm only going to invest $50,000, and rather than trying to bring them into the entire equity round, which is again more complex and harder to do, it's fairly common that you issue a quick little convertible note for that $50,000 or $100,000, and it just supplements the ongoing round.
There also, was another driver to the popularity of convertible notes, and that is especially at the early stage, right? If you think about it, if you're raising money, kind of the first time you're raising money, you've got an idea, you started product development, you need more to really get the product development up and running. But you're not at the stage yet. You don't have traction. You don't have market acceptance, and so it's at that early stage, it's oftentimes very difficult to actually value the company, right? And unless you actually have a traditional VC who's used to doing that and who's able to do that, a lot of early stage angel investors feel uncomfortable, and the entrepreneurs, quite frankly, don't know where the company should be valued. And so convertible debt allows money to come into the company at an early stage and basically, for lack of a better word, kick the can down the road in terms of actually placing a value on the company until a later stage when there's a little bit more traction.
Yeah, and if we go into the next slide, there's a graph. Honestly, I think this has been around for a few decades. It really hasn't changed much. The startup funding cycle, as probably everybody on this call knows, you start off with far too little money, probably from friends, families, and fools, which is what the FFF stands for up there. Perhaps a little bit later, you get some angel money. So people, quasi-professional investors, all of that is likely nowadays to come in the form of convertible notes or a recently emerged variation of convertible notes that we'll talk about later called SAFEs. And then you proceed, assuming we live long enough, get through the valley of death, we get into first, second, third rounds and so on. Those are almost always pure equity rounds because, as Sirk said, once we've got some amount of track record, it makes more sense to get to a valuation that's justifiable by more than throwing darts at a dartboard with numbers on it.
Great. I've got a couple of questions that have come in just quickly from the last slide. We mentioned briefly, that notes are standard for early stage funding unless you're in Roh or ROW. Can one of you guys kind of jump into that just a little bit, explain that?
Rest of the world. Totally standard in Silicon Valley and really, New York, Boston, LA, etc. Much less standard, especially even at early stages. In the middle of the United States, less standard outside this United States. You find really commonly that investors in other parts of the world just don't have any experience in convertible notes, which we can talk about later, may or may not cause you to abandon the idea of convertible notes? I've seen, and I generally would recommend, I'll give you an example. We were recently working with a company trying to raise funding from some investors in Mexico. They really, none of them, although they were all sophisticated, wealthy investors with large personal portfolios, they had no experience with convertible notes. And really didn't feel the need to get up to speed to learn what convertible notes were. And ultimately, we recommended that the company don't try banging your head too hard against that wall, and it's probably in your better interest to go with what they're comfortable with, which in this case turned out to be equity. Even though in Silicon Valley you almost never see anybody issuing equity for a company that hasn't been launched a product.
Great. Thanks for answering that. So moving on, looks like a fish flies like a bird.
So this is what's weird about convertible notes. And you think about it. What is it that the company wants? The company wants funding. What is it the investor wants? Investor wants a piece of the company, a piece of future return. It's pretty rare that an investor actually wants things like regular interest payments, which is what you get from a bond. So this is why this is a kind of a bizarre instrument. Historically speaking, as I said, it was a great improvement over doing a full-on equity round that could easily run you $100,000 in legal fees. That money at the seed stage companies don't have. Whereas it's not uncommon to get a convertible note round done for $5,000 or $10,000 in legal fees. Big change. It's a much shorter document, 5 pages maybe, as opposed to 50. A lot simpler. And again, as you think about it, what investors are really looking for is investment in stock. It just happens to be, however, that a convertible note is legally and financially speaking, and perhaps most important of all, from the IRS's point of view, it is a debt instrument. And so you have to include certain features of debt that neither the company really cares about, nor most of the times do investors really care about, and that's principally interest. So the way these work, generally, you are thinking, an investor is thinking about issuing a piece of the company, or rather obtaining a piece of the company. You get that piece of the company because of the conversion feature of convertible notes. At some point in the future, this debt will convert into stock. And again, that's really what almost all investors care about only. The IRS, however, cares that given the fact that this is technically a debt instrument, it's got to issue interest. And so and this is where we get that sort of half fish, half bird kind of thing. It behaves mostly like a stock, but has a couple of features of debt.
Yeah, and I'll echo everything that Kevin said. From an accounting perspective, obviously there's a big difference between debt and equity, the way that it's represented. There's a few more housekeeping stuff that you have to do on the debt side. But when you really look at kind of what you get in terms of being able to bring in cash quickly into a company, investment from smaller investors or early stage investors, going a convertible debt route instead of a full-on equity route is well, certainly preferential in many cases, and in some cases it's really the only way to go, because you're just not going to be able to do a full equity round of financing. But in terms of how it behaves and the way that we need to look at it, yes, it shows up on the balance sheet as a liability, and yes, we have to calculate interest payments. But other than that, for all intents and purposes, it is stock, it is equity. It's money that's coming to the company that, for all intents and purposes, is not going to be paid back to investors, even if we don't do another round of financing. That money is going to get used up, and so the investor should understand initially that they're not going to get money back, and it's going to at some point convert into equity and not stay on the books as a liability long term.
And we'll talk more about what that conversion process is like and how to propose and negotiate, agree on these kinds of terms. But let's talk through in more detail the particular provisions in a convertible note, what the advantages and the benefits of each of these of a convertible note is. On the next slide, as I've said, it's a short agreement. It's quick and simple. It's boilerplate. I once compared the standard form convertible notes of every major law firm in Silicon Valley just to satisfy my expectation that they really are basically all the same. They're simple, they're pretty easy to understand. They can be really flexible in the sense that you can use them anytime. You can use them for $25,000. You can use them for $500,000. You can use them for a real full-on seed round, or you can use them for a really quick, simple bridge, kind of a just-in-time investment. It doesn't require a company valuation, as Sirk said earlier, which I think is probably one of the most important features of this. Valuations of companies, particularly private companies where there's not a lot of data, there certainly aren't really comps or at least publicly available information about comps, makes it very difficult to assign a valuation. And at that stage, it means that the valuation becomes nothing more than a negotiation. In almost every instance, an entrepreneur is going to be at a disadvantage because this might be the first time you've ever tried to negotiate something like that, and the investor has probably negotiated valuations dozens of times.
Well, plus,
and then
Kevin, I'll add to that also another point about the valuation thing. It also, I've seen entrepreneurs get stuck, right, on valuations at an early stage company. They've got a great idea. They've already made a little bit of progress. And just like, we think of our kids with a different eye than outsiders do, we think of our companies that way too, right? And so, we may have this, expectation of a valuation that may not bear out in the marketplace. And so I've seen entrepreneurs get stuck where they are stuck on the valuation. They are trying to get it, and they're not getting it from investors, and so it keeps them from actually being able to close around the financing, when the most important thing that they should be focused on at this point in time is getting money in the door so that they can focus on product development and customer acquisitions, the two most important things for a company's success. And so this, a convertible debt or a simple agreement like this really paves the way for us to be more successful in the short term, leading to long-term success.
Yeah, and on the next page, summarize the advantages of those particular terms. It's quick, it's cheap, it's flexible, and you don't have to negotiate much of anything.
Now, for the low legal fees, is that, in your experience, either of you, is that a small range as far as legal fees, or can those fees kind of be all over the place depending on the particular deal in place?
It can be, and I sometimes think this ventures on up to the border of malpractice on the part of law firms. I have seen, for a relatively simple early stage deal, legal fees as much as $64,500 for a convertible note. That's frankly absurd. I suspect where that number came from was that there was a lot of negotiation with the ultimate investors, who were, in this case, not very sophisticated investors, and there was a lot of education involved on the part of the law firm, getting investors comfortable with and able to actually make the investment. This is a case where I think almost in almost no case is it worth spending the money and the time to try to educate an investor on what a convertible note is and how it works. If you're sensing that the investors you're talking to really aren't comfortable, really don't understand, recognize that from their point of view, for them to get comfortable making this investment, it probably means they're going to have to spend some time and money with their own lawyer. And if I'm looking at a $50,000 investment, do I really want to spend $2,000 or $3,000 in a couple of hours on trying to understand this thing when I totally understand equity and I'm ready to write that check right away. In most cases, you're going to be better off dropping that. But I would say you can get standard form convertible notes. We'll talk later in more detail about the specific legal terms of a convertible note. There aren't many. And starting from the standard form that any law firm has, it should take very little customization because there are only a few terms that ever change. In fact, to kind of prove my point, when we were developing our online investment platform, we had a theory that investors prefer to invest in companies at this stage, much like they invest on E-Trade. So, if you decided you wanted to buy 1,000 shares of Facebook, and you could go on E-Trade and you can research and decide that this is in fact the company you want 1,000 shares, and you plug in a couple of numbers and you hit a buy button. And when you hit that buy button, you're actually executing legal agreements, although you'll never read them, and there's really no point in reading them because you can't change them anyway. We proceeded on the assumption that investors prefer to invest the same way. We use standard form documents on our platform. The terms are explained, but they're not changeable. And kind of as proof that we were right, although we make it possible for people to download the investment agreements if they want to, nobody ever has, ever.
Yeah, $64,000 for a convertible note seems outlandish, and I agree with you, Kevin, that would certainly raise eyebrows. I think to Kevin's point about it being very, very standardized, and there isn't a whole lot to really review, that there shouldn't be a whole lot of legal fees involved, other than maybe a couple of hours on the phone just finalizing everything. But most of the work and most of the review can be done without legal counsel, since the forms are already standard. It shouldn't cost more than several thousand. Maybe if it's a little bit more intricate and there's a little bit of a few negotiation calls and you want your attorneys involved in those, then it can start getting a little bit more expensive. But unlike a full round of equity, which definitely costs in the tens of thousands, if not into six figures, then you should be able to do a convertible debt, in under $10,000 in legal fees, unless it gets a little bit more complicated.
Yeah, keep in mind, as I said, as we both said, this is a standard document, and so there's very little for the lawyer to do. Often, what happens is the fees go up because the lawyers are brought in to do education, either to educate the investor or to explain and educate you. And you can save yourself some amount of time and a lot of money if you understand convertible notes. In fact, we should probably be charging for this webinar. I bet we're saving everybody $5,000 right now.
100% agree. And if you're a company and you've already been working with lawyers, you know how expensive they are, and so much of this stuff is education, and so much of it is hand-holding that we really don't need. There's so much information now available everywhere, and even if you just do a quick search on Google for convertible debt, I bet you can find out everything that you need to know about it, with a couple of hours of research.
Okay, next slide. Ultimately, the benefit in almost any sale, the benefits of a particular product come down to dollars or time. That's the case here. The benefit of every single one of these features we've been discussing are that using convertible notes instead of equity will save you time or money, or both. So we can go on and talk now a little bit more detail about, so we've talked about kind of what it is, how it works at a high level, why you would use, or almost certainly would use, a convertible note, or as we'll get to later, maybe perhaps a SAFE, which is a kind of a variation. How does it work? I mean, this is absolutely all you need to know on one page of the step-by-step process for closing an investment round using convertible notes. The first, as in any investment round, figure out how much money you are going to raise. And that's not quite as simple as just figuring out how much money you're going to raise. You need to think about how long this ought to last you, how comfortable you are that the funding will be there when that money runs out, which forces you to think a little bit about macroeconomics and politics and the state of the world in general, which probably leads you to think that you ought to be raising more than you actually think you need. A good rule of thumb is figure out where you need to get to, what's the milestone you need to get to before you can raise more money, how long that's going to take, how much it's going to cost you, and then add 50 to 100% to it, and that's probably about the right number. You will provide the general terms of the note, and as we've said, there are only 4 or 5 that actually matter to the investors you're talking to. Those investors almost certainly, almost without exception, should be accredited investors, meaning that they meet certain financial thresholds laid out in the United States securities laws. They're reasonably low, to be honest. It's as little as $250,000 in annual income for the last couple of years, or net worth of at least $1 million, not including your house. And nowadays, the number, because those terms were set decades ago, the number of accredited investors or people who qualify as accredited investors has gone way up. The reason you shouldn't be using non-accredited investors is that the entire marketing and fundraising process changes when you're using people that, by virtue of their lower income or asset base, the federal government deems less sophisticated and therefore requiring more protections by law. It's a harder process to raise money from unaccredited investors, and even after you close that round, you're probably not going to enjoy interactions with those investors over the next several years. Recognizing that if all goes well, you're getting married to a lot of investors, and the less sophisticated, the less used to doing this they are, the more management it's going to take on your part, and probably you're going to find it's not really worth the trouble.
I usually say this, that when people say, well, how many investors make sense and what's the minimum amount and an average amount of investment, I always say try to go for the least number of investors with the most amount of money, because it's not even a matter of, a $50,000 investor is going to require the same amount of hand-holding as a $10,000 investor. The $10,000 investor is actually going to require more. And so you really want to be careful about how many of those you take on and how many you have to interact with, because it will make your life a little bit more difficult than it needs to be.
Or maybe a lot more difficult needs to be.
So
I once...
I'm sorry, a couple of questions have come in. Just at the basic level, how can you easily identify an accredited investor? Is there certain certification to look out for, or is it just as simple as asking? What does that look like?
Yes and kind of. As I said, the requirements for becoming an accredited investor are pretty black and white. How do you figure that out? Well, in most cases, it's enough to require the investor to certify that he or she, or it, if it's an entity, falls into that category. It may, because there can be pretty draconian consequences of getting this wrong. Sometimes you'll find that particular institutions may have greater requirements. For example, SEEDCHANGE is a registered broker-dealer. We not only require investors to essentially self-certify, but we also are required by law to diligence the investors themselves and satisfy ourselves that they are accredited investors. You probably don't need to go to that great a lengths, but it does make sense for all kinds of reasons, practical as well as regulatory, to make sure that you're talking to somebody that's accredited. Now, if you're participating in something like a demo day at say, Y Combinator or 500 startups, those organizations will already vet investors who are even allowed inside, and you can be pretty certain that everybody who's there is an accredited investor. If you're going out and approaching people one-on-one, you're probably going to have some decent sense of well, this is a partner at Goldman Sachs. Chances are very unlikely that she is not an accredited investor, whereas my neighbor operates a garage and works on motorcycle engines. And chances are less likely that he is an accredited investor. So there's kind of a rule of common sense here, but you're still going to want people to certify.
Gotcha. Thank you.
I once worked with a company to the point of why the practical reason of why you want accredited investors, who brought people in, had 70-some investors in their first round, which is the first god-awful mistake. And the second mistake was while they all self-certified as accredited investors, a number of them had never invested in a company like this before. And quite literally, on weekends, even a couple of times at midnight, some of these people showed up at the doors of the lawyers, the executives, the founders of the company, looking for answers about sort of to questions that they had about the company. That's the kind of thing. That's extreme, but you don't want to get yourself into that kind of a swamp. Once you've provided terms to an accredited investor, agreeing on terms, it's usually not a terribly difficult process. As we'll see, there are only a couple of economic terms, and you don't typically have an enormous amount of bargaining power. You're probably going to end up settling for a number lower than you'd like. Once you've agreed on terms, you sign and date both the note purchase agreement, simply an investment agreement. It's a contract that says that you agree to issue convertible notes and the investor agrees to buy them. And then you will issue the note, which is a separate document, a page or two long, and it's essentially an IOU, a one-page IOU, and you'll trade the note purchase agreement and the note for the money. It's almost always a very informal process. If you're doing a multi-billion-dollar deal, there are lots of checks and balances, and everything goes through lots of third parties. It's pretty rare for that to happen at this stage. Most commonly, you ask them to wire or send a check. When they do, you send back the note purchase agreement and the note, and everybody's pretty happy and comfortable with that. And then you'll need to add them to the cap table, which will have a separate section for debt because, as we said, they don't actually own any stock in the company yet.
Great. So jumping over into the terms that matter.
And only 4. It's easy. And let's start with one that I think is really easy. It's interest rate, because you have to pay interest on convertible notes. So the question is how much. I've seen this all the way from 0.25% up to 15%. Both of those are somewhat egregious, although the 0.25 is probably more justifiable given the ultra-low interest environment in most markets in the world over the past 6 or so years. But typically, there's a standard number. Given the fact that it's rare to find an investor at this stage who cares much about the interest that the investor is going to be receiving, it's not one that's worth haggling over, and it's not one that usually investors do much haggling over. I have recently, or typically I've seen people figure this out in a couple of ways. Choose a benchmark, add to it, like LIBOR, or choose a number that's somewhat above what you're getting in a money market account, but still a reasonably low number, a round number, and go with that. The next term that matters is the maturity date. When do you have to convert, or in some cases, pay back the note? It's usually 12, 18, or 24 months. What is the discount and what's the note cap? And the way to think about these two terms, they work together. An investor investing at an early stage is taking on heightened risk, right? Investing a year later is probably a considerably de-risked investment from the point of view of the investor. And so the investor gets a little bit of a kicker for investing at this stage. And the kicker comes in the form of a discount at conversion or conversion under the conversion cap. And we'll go through more details on that. The investor gets to choose one of those two. We'll always choose the one that is economically more favorable. And a little bit later, we'll show you some calculations on how to get to those. On the next slide, so convertible notes interest rate. They all have to include an interest rate. You can't do 0%. The IRS doesn't like that. As I said, two ways of doing it. I don't recommend tying it to LIBOR or any other thing, standard rate, because that rate fluctuates and calculations become a pain in the butt if you've got to calculate what the interest rate is day by day. If you settle on a round number, and I like 5% because it's a round number, and anybody can calculate the interest in your head really quickly and even more quickly and simply using a spreadsheet. 5% is still a pretty common accepted benchmark in most places. I have recently seen it creeping up. I don't totally understand it. I don't generally accept it. I don't think, given the fact that investors really aren't buying convertible notes to clip coupons, I see no point, no justification for issuing notes at 10% interest, which I've recently come across. As interest rates change, although that's really not expected for some years, but as interest rates change, they can't really go down. They can go up. You'll see that 5% number go up as well. Interest is not paid in cash. You're not clipping a coupon. You're not making a monthly payment to the investor. You're just accruing it all. At the time you convert, that amount of cash gets converted into shares at the conversion price. So a thing to keep in mind, the longer you wait to conversion, the more shares you're going to have to issue in exchange for that convertible note. Interest begins to accrue the date the note's signed. It's paid when it converts to stock. And bottom line, my recommendation is always just use 5%.
Yeah, I'll add a couple of points. You know, I've seen kind of historically, you know, the 6 to 8%, you know, is a common number we've seen on convertible notes. I think given today's interest rate environment, that is probably high, and 5% would probably make a whole lot more sense. But you know, one thing that and I think Kevin already mentioned this, if you really do the calculation on a 12 to 18 month cycle of when this is going to actually convert, the difference between 1% probably is not going to be a big difference. And so, you know, keep that in mind when you're thinking about negotiating and you're negotiating each of these points, that's probably not one that's going to be a huge hit to you, even if you have to give a little extra interest. And then from an accounting perspective, just, you know, as the accounting guy, I'll just kind of add that you want to make sure that on a monthly basis that you are calculating the interest on this and taking that as an expense and putting that, you know, making sure that you're accounting for that so that when it does convert into equity, that we convert it to the right amount and it moves the right amount over from debt onto the equity portion of the balance sheet.
Yeah, that's a really good point. You're making sure that your accountant is aware of what you have issued and when. And they'll need your cap table as well as a list of the agreements and the issuance dates and the amounts, just to make sure that they're accruing properly. Super point. One other or just an addendum to that point about the interest rate. I absolutely agree. The difference between 3 and 5 and 7, at the end of the day, who cares, really, from an economic point of view? I do think, though, that an investor is really insistent on 8% or 10%, something that's really non-standard. It is at least a yellow flag about that investor's sophistication and therefore appropriateness for the investor. If you're coming across an investor that's demanding 10% in today's interest rate environment, I'd pause and think really carefully around whether I want that investor on board.
Excellent point, Kevin.
Maturity date, so because remember, this is debt, so it's got to have a date when it's going to mature and be converted. And because it's debt, there is that possibility of repayment. Typically, a note includes the provision that it will convert or be repaid. It's almost never repaid. In fact, I'm not sure that I can recall an instance in the last 20 years when I saw a convertible note actually repaid rather than converted. Typically, the term is 18 months. You can do 12, although I don't really see the point because it is a bit of a hurdle. You do need to make sure that you're going to be able to convert at the end of the period, and investors typically don't care between 12 and 18 months. So why add that speed bump into your life? You might as well go with a later term. At maturity, convert or repay. The question always comes up, well, what if we don't have the money to repay, but we also aren't quite ready to convert because we haven't got the valuation we were expecting, or we haven't yet done an A round, so we're not ready for an A round, so we're still in the same boat we were when we did this in the first place, which is we don't quite know how efficiently to peg a valuation. What do we do? In the bad old days, it wasn't uncommon to find an investor who treated this kind of as debt and forced a repayment, which usually meant forcing a company into bankruptcy. I haven't seen that or heard of that in a very long time. Investors generally get that, hey, if the company isn't in the position to convert because it is just done or is about to do a nice round, it's probably not in a position to repay. I'm probably going to get pennies on the dollar, and what's the point of that? So it's pretty rare that you find a company forced into that. The thing to do is just talk to your investors. Almost always, investors are willing to renegotiate and to amend the original purchase agreement to add a new maturity date. An amendment it's a one-page document. All it says is we agree to amend provision or section 7.8, extending the maturity date to whatever the new date is, and you sign it, and it's as simple as that. It sometimes happens that an investor will want to negotiate and extract some concessions for extending that maturity date, perhaps an additional amount of shares, perhaps some amount of warrants, perhaps a lower conversion cap. Not market standard, but it happens. I don't know if you have anything to add to that, Sirk, or
no. I think that combined with the second point about converting after 18 months is again, to your point, a better reason to just put a longer term in the first place. It's going to take you longer. Trust me when I tell you, it's going to take you longer to hit your milestones. It's going to take you longer to close that Series A round of financing than you think it's going to take. And invariably, what we see, even if things are kind of going according to plan, we see a lot of these amendments to these notes that say, okay, we're going to push it another 6 months, even though 3 months prior it looked like we're going to close the Series A. Those kinds of negotiations and the paperwork takes a lot longer than we think it's going to take, and so give yourself extra cushion on the front end is the better way to go.
So moving on to the two terms that can be a little confusing when you first encounter them and start to think about them. The discount, which runs in tandem with the convertible note cap, is pretty simple. The idea is that I get a little bit extra because I'm investing at the riskiest stage of the company's life, and the discount typically is 20%. And what that means is that if the shares convert at $1 for the new investors, my shares are only going to convert at 80 cents, meaning I'm going to end up with more shares than other people who are investing the same amount of money in the current round. I've seen over the past few years a trend where discounts dropped from 20 to 15, 10, some cases 0, no discount at all. I hated that trend. I think it's not fair to investors, frankly. It's not an objectively even kind of term. And frankly, I think it ends up annoying or angering investors for what? A few thousand extra dollars. To my mind, it just never was worth deviating from what the standard was, which is 20, and has to come back to, in most cases, 20%. Now, if you don't convert, meaning if the investor doesn't convert using the discount, the investor will convert using the convertible note cap. And the note cap is simply anti-dilution protection for the investor. It says that I'm raising money now in the expectation that 14 months from now I'm going to do a Series A. I'm raising $500,000 now. I expect my Series A to be somewhere between $2 and $4 million. And I'm hopeful that I'm going to be able to raise that Series A at something around $12 million valuation. Therefore, I'm going to kind of arbitrarily, because this isn't a valuation, decide that we're going to convert those shares for you, the note holders, my first investors. You're going to convert no matter what the valuation is, even if I do hit that $12 million valuation objective in my mind. I'm still going to convert you at $4 million because that's what the convertible note cap is in the convertible note agreement that we're signing. And the way that works is that rather than getting the number of shares I would get as if I were investing at a $12 million valuation, I'm actually going to get 3 times that number of shares because I'm investing as if the valuation in that future round were only $4 million. And I've used $4 million as an example because that's pretty close to the median right now in Silicon Valley. It was around 4 million, 3.5 million, 4 million for a company with some amount of traction, with some amount of revenue, probably not much, but some amount of revenue, and obviously, therefore, a product that is already being sold into the market. Something around 4 million was the median 4 or 5 years ago. It spiked just like discounts did, and we even saw people raising with no convertible cap at all, which again I think is not a fair trade for an investor, given the amount of risk that investors taking on at this stage. We've always recommended that people stay at what's fair and even, shortens the negotiating process, shortens the lawyer billing process, and ultimately probably produces a better investor relationship. The other reason for using a convertible note cap is that it ultimately aligns the incentives of both you and your investors. So without a convertible note cap, I, the investor, naturally kind of hope your valuation doesn't go very far by the next round, because the lower the valuation at that round, the more shares I get. So I'd rather you not hit that $12 million valuation if I don't have a convertible note cap in my agreement. I'd rather you be somewhere around 2 or 3 or 4, because then I'm going to get a lot more shares, and I'm going to own a bigger piece of the company. If you put in a convertible note cap, then you remove that disincentive. The investors is actually motivated for you to achieve a much higher valuation, because the amount of shares that he or she is going to get is fixed, no matter what the valuation is, and therefore, you know, it's in all of our best interests for the company to grow as fast as it sensibly can, and to get a valuation as high as we can get it to, and I'm willing to bust my butt to try to help you get it there.
Yeah, I think the examples in the next couple of slides will tell the story. You know, I hear some entrepreneurs, especially who are not that knowledgeable about convertible debt, saying, "Oh, that seems like this could be costly to me in terms of, you know, giving up a lot of my company if I actually am successful." But I guarantee you that, you know, the negotiation, like the initial thought about what kind of a note cap we want to put on a deal, if we're hitting that, and if we're surpassing that, such that the convertible debt investors are getting their shares at the note cap conversion, that's a boon for everyone. Right? That's a boon for the entrepreneur and for the company as well, in terms of the percentage of the company that they're going to keep at the Series A round of financing, if we are successful and if the investor is getting more shares due to the note cap conversion.
So we haven't got a lot of time left, and we're not going to spend a huge amount of time on these two examples. I think it's worth you spending a little time making sure you understand the numbers. But if you look at the first column of conversion example 1, these are just the assumptions that we built in, right? And these numbers are not going to be the same for everyone. Then, assuming a valuation in a Series A round of $4.5 million, raising only $1.5 million in that round, so a post-money valuation of $6 million. Here's what will happen if we calculate the number of shares to be issued using the discount, and if we calculate the number of shares using the cap. We see that it's in the investor's best interest, again, using these numbers, to take the discount or get more shares. On the next example, using slightly different calculations, a much higher Series A valuation, although the same amount of assumed investment round at that stage, you can see that it's in the investor's interest to convert using that cap, same note cap, $4.5 million, because he or she will get considerably more more shares and own a much larger portion of the company at that conversion. So you can see the incentive for the investor. My gosh, let's get this valuation as high as we can possibly get it. It's going to make all of us happy. And later, I think I do think it's worth a little bit of a time making sure that you understand how this plays out. We actually have on our website, we've developed a funding scenarios calculator that allows you to plug in numbers and play around and see what happens, assuming certain scenarios, what happens in the future, and how does this work for an investor. The last two things that we want to talk about, while still leaving a few minutes for questions, are I mean, this probably all sounds pretty good. Are there any downsides to convertible notes? There are. It's still debt, and it's not really what investors are looking to buy. They're really looking to buy shares, after all. It does still incur interest. Investors don't really care, but it is some extra amount of cash that are really stock that you're going to have to pay out. It does have a term. It has to be repaid or converted. You know, it's at the very least, it's a hassle if the company doesn't develop the way you want it to, and you're in a bit of a bind at the maturity date. So, you know, kind of a natural question is, why not get rid of the silly stuff that nobody cares about, the debt features of it, and why not give them equity, which is what they really want and what we would prefer to be doing anyway. And the answer is that somebody did A couple of years ago, some lawyers at 500 Startups and subsequently a few other places came up with something that they've called a SAFE. It stands for Simple Agreement for Future Equity. It's essentially a convertible note without some or most of the features of convertible notes. It is an equity instrument, so legally and from a tax point of view, it's equity, it's not debt. You don't pay any interest. This is really the primary point of doing safes, no interest, much simpler. The other terms may or may not exist in a safe. The standard form of safe doesn't include a maturity date, doesn't include a discount, doesn't include a note cap, or a conversion cap, we should call it, rather than note cap. But a lot of versions do, particularly the conversion cap and the discount. So still giving the investor that downside protection and the premium for the additional risk that the investor is taking on. Maturity dates are less common. In fact, they're not common at all. I have seen them, but most often there is no maturity date. The investor is just buying into this on the assumption that, hey, kind of along the same lines of, I don't know when my exit point is going to be. I also don't know when my maturity date is going to be. And investors most often are comfortable with that. You'll find that safes are very common in Silicon Valley, very common in the coasts, in general, among angels or among the startup community. Not at all common once you get out of the startup community. I've recently had the experience of working with a company in New York, working with New York investors. Lots of angel and type investors love safes. The reaction we got from millionaires and billionaires who were not really deep in the tech community was, what's a safe? And yeah, I don't really want to spend the time to figure it out. But I'm happy to write you a check on a convertible note today. And along the lines of the other terms that we've discussed, this is probably not an instance where it's in your best interest to try to educate somebody if they won't take a safe, that they will take a convertible note. Hey, move on.
Yeah, and I'll add, in terms of what we see, we definitely see, typically for companies that are using safes, which we think is a great instrument to the extent that the investor is knowledgeable enough to understand it, is that we typically see some combination of discount and note cap, more note caps than discounts, and we almost never see any kind of a term on the maturity date. So again, all those things make it easier to negotiate the terms because there just isn't a whole lot to negotiate. And yet you're able to get money into the company really, really quickly and easily. Most safe agreements are, I want to say they're like 3 or 4 pages long, one document, very, very simple.
Great. Thanks, gentlemen. I think we're right up here to the Q&A. We've got a few minutes. I've got tons of questions. So thanks to everybody that has submitted their questions. I will try to get through several of them in the time allotted, and like I said, if we can't get them all here, we'll follow up afterwards to try to get as many questions answered as possible. So let me jump right in, and we'll just go down the list as fast as we can. Are both cap and discount options offered on the note, or is one chosen by the issuer up front?
Yes to the first question. They work in tandem. You get to choose one or the other. You only use the discount if you haven't hit. So economically, if you hit the valuation equal to the conversion cap or greater, then the investor is going to want to convert using the conversion cap. It's only if you are below that you're going to use the discount. They work together.
That's right. The key takeaway here is that they're both included, and it's up to the investor to choose which one is in their best interest. It's not up to the company.
Gotcha. All right. Question, I think we may have touched on this answer. This came in a little earlier. Generally, what are the considerations in terms of servicing the interest payments and accruals for convertible debt?
There are none. We're not going to be making payments on a monthly basis. We should be tracking them on a monthly basis and doing a calculation for what the interest is, and we should be accruing for that, and we should be adding that to our liability section of the balance sheet, such that when the time comes to do the conversion, we'll know the exact amount. But there are no payments that are made, just accruals for the company to take on a monthly basis.
All right, I've got a couple of questions around this kind of topic, so I'll try to paraphrase best I can here. Are there any instances, or have you ever run across times where a convertible debt holder or note holder is pulled into corporate governance, like granted a board seat or something along those lines?
Oh, all the time. I've had people ask that frequently. The right answer is always absolutely not. And you get this question most commonly from less sophisticated tech investors, which isn't the same as less sophisticated investors, but less sophisticated tech investors. And you get it much more commonly from the great Midwest in the United States. So it's not at all uncommon in my experience for an investor in the Midwest to believe that investing $50,000 into a company in a $500,000 round ought to get him a board seat and 20% of the company and and warrants besides. In my mind, investors, my experience, investors, and I'm generalizing grossly, investors across the Midwest are still kind of operating as if it's the 1990s, and so you do see that. You'll probably never see it from or hear it from investors coming from either of the coasts in the United States or from a tech environment anywhere else.
All right, let's squeeze one more question in here. When you're approaching a potential investor about a convertible note, what type of supporting documents do you need? Is it the tradition? You need the pitch deck and the financial plan? Is it like pitching like a VC, for example, or is there more information needed, or do we need to simplify it? What does that look like?
That's a good question. It's very much going to be investor dependent. I have seen people, I kid you not, write a $50,000 check after 15 minutes of meeting with somebody that he'd never seen before. I've also seen people take 3 months and want to do hours and hours of digging and diligence in order to write that same $50,000 check. The right answer, or the most common answer, is somewhere in between. It's typical that an investor is going to want to spend some time with you, talking about the company, talking about growth prospects, getting comfortable with you, the team, the product, understanding the market. How much time that takes is very investor dependent. You don't normally have to go through a whole kind of institutional diligence process, but sure, people are going to want to understand what it is that they're investing into.
Yeah, my message to the entrepreneur in this case is exactly that, is that you can expect less due diligence. They're not going to want to go through every single legal document that you have and your insurance and all that stuff. But as entrepreneurs, we should have our pitch deck ready, right? When we're ready to raise money, we should have our story ready. We should have information if people want to do a high level review of your employees and who you have on board and what the idea is and what the market opportunity is. We should have that available, and so prepare to provide that kind of information. But certainly you shouldn't expect them to be crawling through all of our corporate records.
And it's not at all uncommon to have a first meeting with somebody and get homework out of that meeting. So an investor may ask for other information you don't have prepared, and you're going to run home and spend half the night pulling together a different set of spreadsheets or a different kind of or updating your pitch deck.
All right, I've got one more good question that came in specifically about safes. I'll throw it to you guys. Is evaluation needed for a safe?
No.
Awesome. Like the short answers.
An easy one.
All right.
You could tell Kevin wants to go to lunch.
Gentlemen, Sir, Kevin, thank you so much for taking the time to sit with us today. This was fantastic. Everyone that's still here, you will get an email with this recording within 48 hours, and in a shorter run, you can check our YouTube channel by the end of the day. It will also be uploaded there. Thank you all for joining us today, and gentlemen, have a great rest of the afternoon.
Thank you, everyone.
Thank you.